Hello and welcome to this Lunch and Learn how to raise capital in those early stages from, I shouldn't call you a horse, but I was going to say from the horse's mouth, but from someone who's recently been able to do this, Alex Logan, co-founder of Cecil Earth. My name is Charlotte Connell, Ecosystem Director here at Climate Salad. And before I hand over the conch to Alex, I'd like to acknowledge the traditional owners of the land on which we meet. For me, that's the Gubbi Gubbi people. And I pay my respects to their elders past, present, and emerging, and their continuous connection to country, land, and sea. Alex. I will try to mute people in the background where possible. Alex, how did you want to run this? Would you like to have people come off mic or just have questions at the end?
I think, yeah, very happy to make this, a collaborative session where people are asking questions. I can probably prompt us with a few things on my journey, which is still a very early stage journey, so hopefully it's quite relatable. So I can give a bit of background. I can also share a few thoughts, but then very happy to take questions because there's not always the opportunity to ask founders questions about some of the intricate things or what to expect. So very happy to make it collaborative.
Wonderful. And maybe if you like, in the chat, everyone can sort of put in at what stage they're up to, if they're currently cap raising or about to or have. But Alex, take it away. Take us through your journey. And I heard your Evoke Ag workshop or presentation was fantastic. So I hope you bring that to us here.
Great. Well, thanks everyone for joining and appreciates everyone coming along and excited to share a bit of context first, but then also take questions and share a bit of my learning. So just explicitly, I'm a first-time founder as well, so it's not as though I've been through this process over and over again. So have been navigating it with my co-founder for the first time, and it's been at times probably some of the most challenging things that I've done. But we have raised 2 rounds of venture capital. We've raised in both Australia and the US. We've also raised from sector-specific funds, so climate funds, but then also generalist funds. And as Charlotte mentioned, I was part of a panel that was even looking at pre-venture capital funding as well. So I think have experienced a lot of that intimately for the last 2 years along this journey, and have again navigated it for the first time, but had a lot of learnings since then. I guess to just start getting the conversation going, hopefully some of those prompts as well, like firstly, both have raised angel money, venture capital money. What's the difference between Australia and the US if you're considering that? How to navigate, particularly within the climate space, the balance of sector-specific or generalist funds, areas of things that I've navigated. But then ultimately, I think just one high-level theme is just about the relationships at this early stage, and that being core to the experience that you're going to have, and probably the thing that's going to set you up for most success. So what I mean by that is, and to speak, I guess, concretely about examples, not only because I was asked this question yesterday, let's take an example of one of those relationship builds. So our pre-seed round I'm so bad at years at the moment, but at the beginning of 2022, which is just over a year ago now, was led by Tenacious Ventures, which is a ag and climate specific seed stage fund. So that round closed, I think, on the 25th of December 2021. And if you go all the way back and trace it back to our first engagement with Tenacious, it was actually with Cass Mao, who doesn't work at that fund anymore, but that was in 2020. And it was just a friend had sort of got the update that I was quitting my job, and we had a conversation with Cass. And that was, super early. We're just exploring problem spaces. And then over that 12-month period, we started to, make progress and refine the problem that we wanted to solve for, and got dragged into a conversation with Matthew Pryor, who's a GP there. And we had multiple workshops with Matthew through the experience when we weren't raising capital. And this is one benefit, particularly of sector-specific funds, is that you can often engage on theory of market conversations, where you see the world going and the progress that you're making. And naturally, as we got towards the end of that year, we started to do a capital raise, and we had that really strong relationship with Matthew and Sarah and the rest of the team at Tenacious. And that relationship, I guess, to go a step further, has continued to be really strong through this phase of navigating product market fit. And the reason that that's remained so strong, in my opinion, is because we knew each other and had, I think that both Matthew and Sarah really believe in me and my co-founder. And also they believe in the world and the vision that we see for the markets that we're playing in. And those two things, I think, are often overlooked in the heat of the moment of doing a capital raise. But that fundamental, particularly that early stage, just belief in you're going to solve this problem. Maybe the problem might change a bit, maybe the solution may change a bit, but I believe in you and your co-founder. And that comes from building a really strong personal relationship. And then second to that, if things change, which of course they do at this early stage, we don't mind. That's not changing something isn't a dramatic thing, because we believe in that future state and where things are going. So those are just some principles, I guess, and an example of a relationship that we built, which I think is really important at this early stage. So there's some context and background. I can see that there are potentially questions flying in as well. That's a little bit of context on the journey, some of the things that we've navigated, but then also an example of what I think is really important at this early stage, which is building a relationship. I'm going to scroll up a little bit. Great. So there's a bit of a mix of people who are about to getting ready. I think also there's a lot of context as to what the environment is like now versus what it was 18 months ago. And there's positives and negatives of that. So I can speak to some of my takes on that as well. If we go down, great to learn a bit more about where everyone's at. It seems, really at that quite early stage, a lot of bootstrapped angel investment or an angel investor. Cool. I probably won't come and spend too much time on my company, but always happy to follow up and have a conversation. I guess as that, for those who are in those early stages, have there been any questions triggered just from that navigation of building a relationship, or pointed things from a process perspective that you're considering at the moment? Happy for people to jump in.
I love that, by the way. Thanks, Alex. Because what I'm really moved by is the fact that you've already articulated a matching chemistry. And I was just wondering if you've seen examples of where chemistries like that haven't turned out. Are there such things as investor regret?
Sorry, what do you mean by investor regret? Just as
I'm coming did you really would you regret accepting money from someone you wish you hadn't?
Oh, right. Okay. Yeah, I thought you were talking about, do investors regret not saying no to me? Hopefully.
No. We want that.
Understand the question. So fortunately for us, that hasn't happened for us, but we've certainly navigated through a lot of things, and in retrospect feel as though we've at times dodged a bullet, I guess. And I think have mentioned this in other conversations I've had in the past, but there's a big difference between sort of awareness and interest, and then a meaningful relationship to go on the journey. And the matter of the fact is, raising capital, it may be so urgent that you just need to take on that risk and take on things that are high level interest. And that can lead to disappointment because inevitably the decisions probably no if they don't intimately know you, but also at the same time, you can expose yourself to that risk. So fortunately for us, essentially every lead investor that we've ever had, I've known for more than 6 months before we actually did a capital raise. So I think that my experience has been positive because of that. I think though the warning signs of what I have seen is often I'll talk about, and this can feel really good at the start, but you might send an email out for most of you who are working on really strong purpose-driven organizations that are connected to climate. You could write software and climate tech and send that to any GP at any fund around the world, and they'll probably respond to you right now. It's a sector that has a lot of heat on it, but so that can feel good, and maybe it's a Sequoia, maybe it's an Excel, they'll all respond to you, and like you have to put your ego aside and say like, okay, well, that's great that they've responded, but coming back again to those fundamentals, do they believe in me as an individual, and do they have a clear vision for what that market needs to look like? And I actually, to speak to some examples of how my process has changed going through this journey, I remember being on initial calls with venture capital firms, and I would have like at that stage like come up with a script for exactly 30 minutes. I got my fucking 30-minute call with this VC. I'm going to wow them and get through all my job points. And then the first thing they'd say when they'd get on is, should we tell you a bit about our fund? And I'd be like, all right, hurry up. Like, tell me about your fund. I got to like get my 30 minutes. I've only got 25 minutes down now. And I think that the wiser me now, actually, if you were to engage from an investor perspective, I would probably actually try to spend like 15 to 20 minutes actually hearing from them what they see as the future of these markets. And that's for those of you who have worked in sales, it's a much better sales tactic to get the other person talking for longer. But it's just an interesting thing, particularly in the heat of the moment, the connection that you have with this business. What you want to do is get on there and give them the 30-minute amazing pitch with all of your slides. But in the reality of it is they need you just as much, and you should really deeply understand about their fund, and particularly as many of you are probably experts in the field, pushing back and saying, do you actually understand what it's going to be like for the world to look differently in this industry? Because if we project that out to a positive relationship over 5 to 10 years, there will be different points of navigation. And if they don't, and they're fed up with these changes because they don't actually know what that vision is going to look like, that's when I think it can get a little bit challenging. So hopefully that helps, Julie, as to some of the different ways in which I've navigated it.
Alex, when you say you write out to someone, because that's a great action I'd like everyone on this call to do after this workshop, is to send an email out to venture funds, not sorry about SVB, but climate technology. But how do you reach out? Is it, hi, I'm doing a cap raise, or is it more like, hey, I've got this great idea, great company, this is our vision, we'd like your advice? Like what's the sort of impetus for that reach out and direction of that first initial contact?
Well, I think there's there are scenarios in which you are actively raising, and that's very different to being earlier in the process and just building relationships. So I think that in most cases, investors will say DMs are open, or like send me an email. That they get a lot of those, so it's difficult to stand out. Often, particularly at that earlier stage, finding a way to have a conversation like we did with Cass at that very early stage with Tenacious, just to talk about the problem space and understand how they're thinking about things and what they're seeing in the market at the moment, can be but again, if you're actively raising, you probably can't just start with like, hey, let's get a coffee and talk about the future of whatever it is. So I think it depends on where you're at in the process. Now, if you're at that later stage of actively raising, then you might have to be like more direct. But I think at the same time, it's just the more direct you are, the more reactive they're going to be. And again, they're reacting to the idea, not you. So you've really got to find the right different channels. And I think that's very subjective to where you are at the process. And if it's any advice, go earlier and build relationships. But if you're in that situation of actively raising, then you might have to be more tactical about that. And it becomes a real negotiation from that first email. So it's tougher the closer you get to that breakpoint. So always start earlier, and that will give you more leverage to understand that individual.
I'm sure, like, jump in with questions. You can, be so polite as to raise a hand, or you can just take yourself off mute. But it is interesting because I talk to a lot of companies and they just feel like it's too early, and, it's too early to have those conversations. It's too early to pitch. But you actually started that conversation with Cass when you had just quit your job. So Cecil was still a sort of a twinkle in your eye.
Yeah, it was. Yeah. And I think Dan asked a question around like how solid our grasp of the problem was. I think that our original insight that we had, which was a constraint on supply of carbon markets, particularly in nature-based solutions, hasn't changed. So that initial insight we felt very strongly about. But as we've learned more about incentives and speaking to more people, we certainly have crystallized where we think that problem lies for us to solve. I think that it was, I believe we had a very, very strong hypothesis. And in fact, before we even quit our jobs, I was working for a Singapore project, and I was spending the mornings from 7 a.m. till midday until they came online just doing interviews. So we spoke to about 100 people before we'd even probably crystallized that even like strong hypothesis. So I'm not surprised that hasn't changed, but at the same time, that nuance around the initial insight and how we're going to solve for that, and we're always coming back to that. And I think that's just fundamental to building a business, is really understanding that problem. So I think it was a strong insight, but we've continued to refine that, and as we've gone. That was in response to, I think, Dan's question. I also see, Joe, you've asked a question just around drafting terms. Might need without like oversharing, or it might be like an offline topic. That's a long way down the, maybe a bit more context. Do you mean start to think about what a round might look like, size of round, and therefore valuation? So internally having a view on what that round might be like, or do you mean like in a term sheet?
I guess like there's a lot. We're doing a lot of those early conversations, building those relationships, and a lot of the young guns are basically going right to valuation. And you have terms, is your lead, yada yada yada. Like they're trying to extract molars from you as soon as they can. So you and I have talked about this maybe 6 months ago, and I did want to kind of get feedback again about like the best tactics to do something like this. I'll give you an example. Ex VC yesterday said, "What's your runway? What's your valuation? How much are you going in for?" And I'm like, shit. Well, if I told them all that, then what leverage do I have? So I think term sheet's my way of encapsulating like what's the tactic there. What do you think works best in a situation like that? And for context, it's seed round.
I think this is a really good topic to bring up, just because I think it's such a new, like, how many capital raises do you do in your lifetime? And most of the time you've never done one before. So you're getting thrown into like a very intense situation really quickly. And I've found that, just personally at times, like really difficult to manage. So I definitely empathize with the situation that you're in at the moment in getting those questions. I think what you've really got to do is understand why they're asking that question. What is driving that question about valuation? Are they trying to, again, test you individually? Like, how am I going to negotiate with Joe? Like, and if they're doing that for that reason, if we come back to those foundations of early relationships, then maybe that is a good thing, because they're doing it in the spirit of, I'm trying to get to know Joe and how Joe negotiates. But that doesn't, again, if it's from that perspective, they don't really need an answer, or do they care about an answer? They're trying to understand your thought process, and you can deflect that to either ranges or other things. And that's more about your personal style of getting into that pointy end of the conversation with someone. But if that's happening at a stage where you're feeling comfortable, I would question, like, why does it feel wrong? If are they asking the wrong question to you? Why aren't they obsessing over like what your product is and what the problem is, and getting to know that part of your business more? So it could be a green flag or a red flag. I don't know the person. I don't want to pass judgment, but like, depending on the context around it as to what they're seeking out from that question, if it's about getting to know you and understanding and believing in you as an individual, then that could be really positive. But if it's just coming from a real frank perspective, like, well, this is in times I've sometimes used this as a tactic. It hasn't always worked that well, but this is my business. Like, it's worth billions of dollars. Like, I mean, that can come off very wrong, like, because you're an early stage founder, but like, why are you asking me that question, right? Like, what is it about that question? Is putting it back on them a bit, and what are you trying to understand from asking that question? If you're trying to get to know me, then like, this is my style for understanding where we're at as a business and what a round might look like and what we're optimizing for, and what the next milestone is. But yeah, I'd be really curious on your side just to understand why that person is asking that question.
Great feedback. Really appreciate that.
Yeah, good luck with it. I mean, yeah, I hope that it's coming from a good place, and it's about building that relationship. But yeah, there are other scenarios where it could be something where it's just the wrong question to be asking, and you're well within your rights to like either feel uncomfortable about that or be excited about having that conversation.
Well, I think there's a bit of a puppy mill for VC as well. So it's kind of like they have to ask those questions. I know it's kind of a janky thing to say, but like okay, we're not going to move forward unless we have that information. But I'm like, am I prepared to give it to you right now? And I guess that's kind of what I'm asking is, at what point do you show your cards? Because that comes back to the term sheet aspect as well, like you controlling the deck in your hand. I know you have some thoughts on that.
Yeah, I think maybe a question back again, like if we're role playing a little bit here, like what does a seed round look like to them at the moment? So play into like what the current climate is like. Well, I mean, let's have this conversation. What are you seeing in the market for seed rounds? They must know enough about your business to get a sense of where you're at. And yeah, maybe 12 to 18 months ago, it could have been 5 on 50. Like that could have been a seed round like that in the hype of like what was going on, particularly in the US. That's like one end of the spectrum. Like maybe it's 2 on 10 now. I don't know. Like, so just understanding from them again, what's their process and what are they seeing in the market to allow you to get a bit of an indicator as to how they're thinking about this. Because again, if they're wildly off and they're saying that they're going to do 250K on something else, then you've also got a pretty good indicator. We're not even within 15% of each other as to like the ballpark that you think is required. And then it's not a meaningful conversation. So I think, from a sales tactic, getting them to talk a little bit more and what are they're the ones who are seeing all the deals, right? They're in the market right now doing seed rounds. If they're a seed fund, what are they seeing is reflective of the market at the moment.
Can I ask something further to that?
Yep.
About Joe, because like I think, not only for VCs, but there is sort of like unintended power dynamics as well. And I think I really like how you've answered that question. What I was asking then was sort of how to also develop and angle it for your partnerships as well, for commercial partnerships or joint ventures. It's just such a interesting tranche of hidden agendas or synergies, and it is ruthless and cutthroat in sectors of business.
So as and I think there was, and maybe it was you, Julie, who asked the question just around like corporate venture capital and the role that has to play. I think, yeah, that is and it's particularly important for many climate tech organizations, because a big part of the transition is going to come from large organizations. So it's particularly relevant in what is a very broad category of climate tech. But I think that, yeah, there'd be many people on the call who potentially have big corporate customers. So I haven't actually had experience in executing this. I mean, my previous job was working at Digital Ventures at BCG. So I was working on setting up a lot of these corporate venture capital arms. So I have experience of what it is on the inside there, and then have been in conversations with corporates. And I think the surface level thing is always, we'll do a trial and then maybe we'll invest eventually. I'm sure everyone's probably heard that, like that sort of like quote, which, yeah, I think ultimately you want to get them on as a customer, and that's a priority. But you've got to ensure that you're adding that value to them. But I haven't actually gone through end to end, so I'm not actually the right person to necessarily speak to what happens after that. I will say though, on the actual corporate side and what I've seen as to what goes on within that corporate side of things, it is going to be a very different style process. I would imagine there's probably a steerco that runs that arm. Some of those are getting more autonomy, but you can expect, just like a larger corporate sale, that there are going to be a lot more stakeholders and a lot more sign-off. So granted, that probably is taken for granted, but I haven't actually gone through that process to the end. But I think it's worth mentioning that, yeah, you will always hear that, yeah, let's trial the software and maybe we can become an investor. And that's something that you can use as leverage, but I think I haven't certainly gone through that full end-to-end process. Other people have navigated that really well. I think a team that's done that particularly well is Regrow, which is an Australian company in the agricultural space, who have Cargill and others. Yeah, I think they've gone end to end, and that's something that, well, that might be a place to look at how they navigated that as well. But can't speak to what it's like to go full end to end in that case, but definitely empathize with the initial reaction of that being their way of commercially engaging with you. Great. Any other from other folks? And happy, like, there were some bootstrapped founders on here looking at alternative models and maybe whether or not identifying probably whether or not venture capital is the right thing for them or when. So also very happy if there's at an earlier stage, or even considering like what's the right time to engage with venture capital. That's also something that I can speak to.
I'll chime in as I'm eating my noodle soup. Yeah, we're bootstrapped, and I mean, I've had kind of early conversations with VC firms just to kind of see, like, I didn't have a starting point at all, so I just kind of threw it out there and just kind of tried to start a conversation and see where it goes. And for me, I'm just in the process of like letting them know who we are and just kind of building that relationship in the background, but also using them for market research to see what they think of what we're doing and what we're up to. But I still think we're probably, like, until we get our version 2 of what we're doing up and running, I just think it's like a waste of time. And I would rather come in with a stronger product. So from my point of view, bootstrapping and raising revenue helps us go from prototype and MVP into version 2 that's shining a bigger shiny bigger product. And then I think that gives us, you know, a better conversation with the investors, but it also means we've answered some internal questions ourselves. So just from my point of view, I don't see raising with VCs and angels as kind of like the be all end all. I'd rather probably get debt financing. And then if the right equity partner came in, it would be a strategic investment from our end, because I think we could probably get money from other sources as well. So I see bringing, and this is just my opinion, I see bringing another equity partner in as something more strategic that could help us unlock opportunities versus just give us the money and we'll build some stuff and that's the end of the story. So that's my thoughts on the subject.
Yeah, well, I think what you've articulated there, Chris, is really important and something that is often lost in like just going to, and frankly, have been guilty of this, is optimizing for the venture capital process as opposed to optimizing for building a really strong business. I think we often get caught in that world, and ultimately, one of the biggest responsibilities for you as a founder or a co-founder is to know where your business is at right now and what's best for your business. And I think that can be really hard when every second like LinkedIn post is about raising a bunch of capital from VCs. And then you like look up resources online and it's very structured in, well, after 6 months, you should do your pre-seed round. Then another 6 months, you'll be doing a seed round, and then you can do a Series A straight after that. So that like cookie cutter approach can be a trap of, and then plus the intensity of other people raising money can really force you into forgetting about where your business is at, and actually just like following the crowd. And I think to speak to an example of that, and I think it's a big responsibility for the founder to understand that and to really have a place where you can remove all of that noise and be like, where is our business at right now? And what does our business need? And in that very vulnerable state, other options might be better, or you might still be 12 months away from being ready for an equity partner, as you say, and that's okay. But I think with all of that noise that we always see and that we have filtering through, it can be really hard to get back to those fundamentals. And that can have a significant impact on your business if you like very quickly fall out of touch with where your business is actually at, and you're just putting things on a screen that fit into knowing the problem and the solution and the project you have to pull through.
Yeah, and I think a lot of startups as well, just from being in the traps and just speaking to a lot of people at early stage as well, I think they get into the trap of thinking like, hey, I'll just raise some money and then I'll build something cool after the fact, and then I'll figure out how to run the business, where I kind of inverse it and think, how do I run a great business and how will VC or equity money help me run a better business? So I think the trap is like people think, I'll just raise money and that'll solve the problem. And I think that would be a horrible position to be in, because then you've got, you know, this giant investor monkey on your back who wants their returns and you don't really have the answers. So I think it's far safer to just focus on building a better product. And then when you've nailed that and you're very confident in your direction, then go ahead and raise from there. And that's just, that's how I see it. Yeah, no, I think it's a really rational, almost first principles approach to like building a business. And that's a proven method of being successful. And it might take you 6 months and you need to accelerate, and that's great. But it also might take you 3 years of grinding away at like finding product market fit in many different iterations. And that's also perfectly fine. I think, as you say, as soon as you fall into the trap of following a path trodden by someone else, it can be really dangerous. And it's difficult to do that as well with a lot of the noise around you. And someone else with a similar idea raising 100 mil or something like that, it's just demoralizing at times. But you've just got to come back to, are you thinking about those initial principles and are you making progress on that? And it might take you longer, but you've got to come to terms with that and make sure it's still the right thing for you to be doing.
Can I ask and add to that question though? Like, I mean, when you're talking about personal development as well as a startup and discerning the best interest of your company, say like impact, where a lot of us in Climate Salad care about impact. But then there's that point where VCs might be steering the impact. I mean, how have you controlled your ownership so that you can still maintain or navigate the ship for your highest and best purpose that you aspire to?
Yeah, I think there's a lot in that question. There's a few different ways in answering it. I guess you're talking about a governance piece there around control of the business, and at different stages you might introduce board members or a chairman or an independent director. So there's a category of understanding what that should be, and I think at times, particularly in Australia, we index towards introducing too much governance at a very, very early stage. I think that it obviously has a very important role, and in particular situations, it can be very valuable, and that's something for you to make an assessment of. But at the same time, it can rushing into that type of governance just because you're doing a round and this person is investing and therefore they need a board seat and these terms, it comes back to that negotiation around that round and what that looks like. So there's certainly like an entire topic to unpack there around governance and how you navigate that. And again, there's no right or wrong way of doing that. But I do think that again, if you rush into a decision and don't have a strong relationship with someone and truly understand what is right about that governance setup, then yeah, it could get quite challenging. But the other point is just ensuring that you're and that also comes back to equity and those types of things which influence people's rights over governance. So there's a lot of technical stuff there. I think again, I know I keep defaulting back to that point around the relationship, but what that would sound like to me is if they don't believe that impact is really important and that is the future state that you want to see, then I can imagine how a deterioration of that belief would lead to them wanting for you to optimize for different things. So it definitely makes sense that could happen over time. And that may be more subjective than objective. Objectively, probably on the governance side, and then having control over your business to change the direction. But even more importantly, subjectively, do they change their mind about like, is it worth like doing all this for the impact? That's not a great situation to be in. And you'd hope that relationship with them is strong enough that that wouldn't change over time. But it definitely can, and it definitely does happen. So it's something to be, again, it's good foresight to know that could happen, and only emphasizes, I think, that ability to build a relationship with the investor.
I think where I'm coming from is asking, and I don't want to hog any of the questions, so I'll let other people ask, but I'm coming from that angle of, have you already worked out your exit strategy so that, because I mean, I'm already suggesting, what is it like when you get married, you sign a piece of paper to split your funds or something if things go pear-shaped. I mean, have you figured out exit strategies when going? Yeah, that's it, prenup. Thanks, Charlotte. Have you already resolved your prenups with all the VCs you've signed up on and how you would respond? And this is a very personal thing where you got to imagine, like right now we've birthed our baby and now we're imagining divorcing our baby. It's just such an extreme of two, because I'm like Chris bootstrapping, MVPing and inventing. So I'm probably a bit more hands-on and gritty from that level.
Yeah. So the way I'm going to answer this is, if there are any investors listening, obviously this business is going to be worth billions of dollars and we're going to make heaps of money. But like what you're actually asking me is a more personal question. And I think that on a founder to founder level, you should be, it's important to consider those different options, because you are signing up to what is likely going to be the hardest thing that you've ever done before. And there are chances that it won't work out. So I joke about that first point. Obviously we're all ambitious and want to change the world, but there are like significant realities of being a founder, and there are different, particularly in this climate, there are harsh realities about what may go to zero what may result in, I mean, let's use an example, right? Like last Friday, there were a bunch of companies that could have been ended because of bank collapse. So these are like, you're putting yourself in a high risk scenario, and you need to understand that. Beyond, I don't think having an exit strategy necessarily, but in committing to this journey, you really should have considered the more likely outcomes and what that's going to mean for you on a personal level. And I think that what's challenging about that is that it can in some ways like exclude people from going on that journey, because you can't afford to put yourself at that type of risk. But again, I think as Chris pointed out, you don't need to jump on that train and significantly increase the risk unless you make that decision. But yeah, these are risky scenarios, risky markets. And yeah, I've definitely considered all of those different options. And I'm fortunate enough to have, even at this point, I feel very privileged to have been running a company for 2 years and to have all the experiences that I have. So if you're in that type of mindset, I think it doesn't matter so much about that exit strategy. This is a journey that I've committed to wholeheartedly, and I accept the risks of a bank crashing and my company ending overnight, but also am ambitiously looking at the level of impact that we can have as a business. So that's a more transparent, like founder to founder response. It is it's not something to take lightly, and considering all of those different options, as opposed to just blindly looking at the ambitious outcome, is really important. Cool. Are there other questions from folks that are either in particular scenarios or yeah, again, sometimes it's not always appropriate to ask directly, but yeah, happy to follow up if this has triggered like a very real scenario that you're in at the moment, at the back end of a negotiation, and you don't want to reveal that publicly. Happy to take those questions offline, but yeah, hoping this has been enlightening in some ways. And also, yeah, for other questions, please jump in.
Yeah, I've got one quick question. Kind of, we've been doing the hard yards to create the energy. You've got a little safe round, created energy and FOMO, so now we're probably oversubscribed on that, and trying to like take people to take smaller positions, which are not really keen on because they've got the interest and conviction. Yeah, just kind of keen to get your view on the outlook, considering what happened on the weekend, and the viewpoint that things are just going to get harder and harder over the next 18 months. Do you have any view around that? So if there is a bit extra on the table, is it a good time to look at taking that?
Yeah, I think can respond to the two parts of that. One is the difficult conversations once you have leverage. And then the second piece is the outlook over the next 12 to 18 months. So to answer the second question first, like, yes, cash in the bank is obviously going to be like crucial if you're in that type of business again. So funding is difficult to come by. It's a much more challenging environment than it was before. So the short answer to that is in an equitable way, if you can find access to funding, that is going to be useful, because things are going to take longer than you expected. These impacts around financial markets can also delay partnerships and customer relationships. So I think being in that headspace of maximizing that is important. So that's my outlook at a very high level. Like, yes, capital is crucial at the moment for early stage companies and hard to come by. So coming back to the first question, which is those hard conversations with individuals that you want to essentially look for smaller allocations. There's again a few different ways to view this. I think that thinking more broadly about the construct of the round is one way of looking at it. and thinking of alternatives. I don't think that having, if you're doing safe notes, like stacking of safe notes and putting people into different categories, that can be destructive from a founder's dilution perspective. So there's a lot to be wary of if you start having and you use valuations of a way of including other people. So there's a big consideration that I would say, just if you go down that path, but it is important to take a step back and look at the broad around where the valuation is at. If there's so much interest, would they be interested in increasing that valuation? Just again, from the broader perspective, I think it's important to consider that. I actually, to speak to an example, in a more recent capital raise, did a priced round and then managed to find more allocation through additionally having safe notes. So again, I think it's a different situation for you. In stacking safe notes can be highly diluted, particularly to founders. So I would caution on that. But again, thinking about the art of what's possible to maximize capital, broadly speaking, is a smart thing to do. When it comes down to those conversations, I think that's a good test of the relationship of like a really difficult conversation to have with one of these investors. So facing up to that, and if you truly believe that it's better to introduce another person, and therefore they're going to have a smaller allocation, or you're going to increase the valuation, that's a really difficult conversation to have. But it's a good test of the relationship. And what I found was there were teams, again, not speaking in specifics here, but who did, in fact, I had a hard conversation and did not come in on the priced round, but came in on the safe note round because the difference wasn't meaningful to them, but it allowed us, and it was the right thing for the business to have more capital. So I would really encourage you to have those difficult conversations. Again, I would take a broader look at what is right for the business, and thinking about what is the right round for your business, and then coming back to that and saying really confidently, this is the right thing for us. It means that you have a smaller allocation, or it means that the valuation or the terms have changed, but this is the right thing because these awesome people want to get in. And if you truly believe that, and they're the right partner, then I think you'll have a good conversation. But it is a testing one, and I think, yeah, I felt super uncomfortable when I was doing that in previous times. But I think it ultimately it is a really important part of your skill set as a founder to be able to have those conversations. So I would encourage it, and a bit of work beforehand. And to that macro point, if it's enabling you to access more capital, then that's a solid thing to be doing in the current climate, based on financial situations, how long it's going to take, the impact that might have on partners and customers. More runway is very advantageous. When you look at the companies that came out of 2008, they were the ones who were able to conserve cash, didn't get ahead of themselves, and were setting up really strong principles. And there are a number of fantastic companies that came out of that era. So yeah, doing a bit of research on what they did makes sense, but they all had capital and they used it very efficiently to get through that phase. So yeah, that's my take.
Thank you so much for your time, Alex, and to dip into your brain and networks of how you went about on these two successful raises. And it's great meeting investors in the US who were disappointed not to be on your cap table. So that's always a good position to be in. Just finally, does it help going into building those relationships with your co-founder? Because you obviously have a different set of personality, but skills and traits that are complementary, or does it not really matter?
It definitely matters. It's extremely important. And no matter what unique skill set or personality that person is bringing, that is probably the most, if I was to rate like importance of relationship above we've spoken a lot about in relationships with financiers and investors, but above and beyond that is your co-founder. That's your ride or die like sort of person, right? So that would be a key indicator for also the success of a business. I mean, I think there's crazy stats about like why businesses fail, that running out of money is one of them, but also co-founder relationships. So the right investors are going to want to see that relationship intimately. In fact, I've been a part of multiple more emotional intelligence like interviews with my co-founder, which we embraced and loved, because it's a really fortunate thing about us is I have a great relationship with my co-founder. So I think the nuance that you're asking though is like the different style and like how you can ensure that you're both contributing. Yeah, I think naturally people would expect that there are diversity in the co-founder group, whether that's 2 people, 3 people, or whatever it might be. So that's expected, but fronting up and showing that irrespective of your diverse skills, you know each other really well and you understand that, and you're actually embracing that as a skill set is really important. So yeah, I would say that it's almost on top of the list. I mean, you can, resourcing wise, maybe one of you, like, I mean, the way that we do it is I normally like meet with people for the first time, but then like very quickly, like my co-founder Rory is in that conversation and it's important. So again, it will be a crucial part of that relationship. And I think the right investor will be extremely conscious of that. But there are practicalities about it as well. You can't also, your co-founder might be technical and building things, and you're building the relationship. So there are practicalities about the amount of conversations you're going to have. But I would say, yeah, from a principles perspective, it's extremely important.
Wonderful. Well, thank you so much, everyone, for your time today. Thank you so much, Alex. I know you're incredibly busy building great products and, helping the world manage their natural capital better. But it was really appreciative to get the perspective of a founder who's recently gone through this and to help give back to our community and see who else can benefit from these conversations. So thank you so much, everyone. I have recorded this. So in case you missed it, you'll be able to share it out afterwards.